Apartments today are looking more and more like hotels. They're offering shorter lease terms and more amenities and services. This is especially noticeable in urban, dense markets where people are trading space for more conveniences. But landlords and investors have long valued predictable long-term income streams that come from multifamily apartments. What does this shift in tenant demand mean for them? How do they deal with the risk of offering a lease term that is shorter than 1 year? And is the added cost of offering concierge services or building out a gym in the complex really worth it? In this video, we sit down with industry experts to talk about the newest business models on the market. And we ask them, how do you future-proof your assets and how do you underwrite for these added costs? Harriman Capital develops co-living buildings and partners with Common, a co-living brand. Bringing in a third-party brand that could add hospitality elements to a property is one solution that landlords have found.
Normal real estate risks of buying land, going through entitlements, dealing with, cities, dealing with lenders, dealing with construction costs. Construction costs have gone up a lot in the last 10 years. So, your normal development risks are associated with that. And then obviously there's, sort of the newness of the model, which is the other risk, right? But I think as we invest in these deals, we're getting paid for that risk.
You need to build and deliver the amenities that are going to sell the lease on the way in and retain the tenant once they're there. It's that feeling like home, changing those amenity spaces to align with how people are living and working today is really important.
So how much of the space is furnished already?
So the entire apartment is furnished. And if you walk into the kitchen, I'll show you everything that the kitchen comes with. We're going to stock not just dish soap, but also hand soap, bags, toilet paper, paper towels, and a handful of other cleaning supplies. Things that roommates typically fight about who's going to go buy.
Much like a hotel,
so we also
Common doesn't own the building, and Harriman doesn't hold equity in Common. But the landlord and the co-living brand can achieve a mutually beneficial relationship.
On a building level, each room in a co-living suite might rent for a 20 or 30% discount to a studio apartment. And that's including cleaning, shared supplies, Wi-Fi, utilities, and it's also fully furnished. So renters are achieving a pretty substantial discount while the building is generating higher rent and higher net operating income per square foot because you simply have more people per square foot.
All of these cities where a lot of these buildings have now come online, there's still significant housing issues, especially in an affordability level. So co-living is a solution to that. I view it as a positive from the landlord's perspective, especially because we're investing in super urban areas where the pipeline of tenants for this product, there's typically a waiting list in most of these buildings. So it's not like that person's going to leave and now we're going to be vacant for months.
Whether by bringing in a hospitality brand, developing an in-house solution, or taking part in a joint venture, private real estate is being forced to adapt to new tenant demands in order to future-proof its investments.